All right, let me know when you guys can see the screen. We will be good to go. Yes, you can see. Very good. Thank you. All right, where are we? As you can hear, my voice is not exceptional today. Very annoying. Okay, that's indexes are flattish, not very exciting movement so far. So what were we going to talk about today? I forgot what the topic of this thing is. We were going to talk about new portfolio making, I believe. Let's see what's been going on. We'll go to FinViz and we'll see what the futures look like. Okay, so, oh, you know what I found out with FinViz? If you go to dark mode, you have to go to dark mode, which I don't like. But when you're in dark mode, you can do hourly charts and 30-minute charts and 5-minute charts and 3-minute charts. You can't do that in the regular mode. So we said 2 hours. That would be nice. Then you can see like 5 days. But as you can see, we're generally downish for the day, but not very much, especially considering we had a big day yesterday. Let's get back to light mode. I'm already annoyed with dark mode. Okay, so that's where we are on the hourly charts. But on a daily basis, we've had, this is the thing. You say you had a good May. They always love to randomly define things. It's like we had a great May, had a great April. Although April really ended up where it began, and now May is up a little bit from where it started. And on the whole, though, we're still not back to where we were in February. And if you take that further back, February was a so here in December, this is December, and we still haven't gone back to there yet. So I mean, we have so far wasted the first half of 2025. And we cashed out. I don't even know where we cashed out anymore. I think we cashed out about here. All right, when did we cash out? Let's make sure we got our dates straight. Home. And why did we cash out? We'll talk about that too. So let's try to be a little bit organized today and talk about things logically. I can put this a little close to my mouth because I'm not projecting today like I usually do. All right. So top trades Thursday, there it was. Okay, May 15th, that's when we killed it. So that was a webinar. There was a webinar, I'm guessing May 14th was a Wednesday. Who knows? Yes, 14th was a Wednesday. So in the webinar on that Wednesday, we talked about should we cash out the portfolios? And then when push comes to shove, this is May 14th, let's remember. I can do this on the hourly chart. So here we are on May 14th, and on May 15th, we had a bump back to 59.50. And I said, you know what? If you're going to cash out, you want to cash out when the market's doing good. You don't want to cash out when the market's doing bad. You're going to get bad prices. We had a very nice recovery, especially when you think that we were only at 5,600 the week before that. May 7th, we were at 5,600. So there are a couple of factors in play. Factor number one is even though we had our hedges and even though we did great and even though our portfolios on the whole did very well and held up and whatever, we still had a 20% drop. And what do we have a 20% drop because of? We had a 20% drop because of tariffs, basically. Because the tariffs just don't work. They're very dangerous. They're going to lead to destability. And it's and as they were enacted, everybody said this is going to lead to a global recession. It's going to crash the economy. It's going to crash corporate earnings. It's going to destroy what spending power the consumer has left, blah, 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 blah. Okay. So why did we recover? We recovered because Trump reversed the tariffs, because he said, no, I guess I'm not going to do it for at least 90 days, blah, 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 blah. Not, I'm not going to do it ever. I'm not going to do it for 90 days. I don't get the rationale of the markets recovering to that extent. Like, okay, like if I'm a life insurance company and I'm supposed to insure you, and I'm going to insure you and write you a policy that says you're going to maintain you know that you shouldn't go down more than 20%. I've got good reasons to believe that we historically haven't had any severe instances that would cause you to go down 20%. So I'm willing to write the insurance policy here for a certain amount of money. Now, a month later, 2 months later, you're down 20%. And I'm like, holy shit, thank God I didn't give you that policy back here. And now you come back and say, can I have that policy now? I'm like, no, what are you insane? You just dropped 20%. There's no telling what you're going to do. And has the situation improved? Has anything changed? Oh, yeah, you know what's changed? We have 90 more days. and then it's going to do it again. This is no reason to invest. It doesn't really make sense to jump in and everybody starts like putting money in as if nothing ever happened. Something did happen. Okay, like, you know, it's like a horror movie. The killer is in the house. You know he's in the house. he's stalking around somewhere. Someone is going to die, and just because he says, "Oh, it'll be tomorrow," that's no reason to keep hanging out around the house and see what happens. So, you know, Trump is the psychopath with the knife stalking around the house, and you can decide to go back in the house, or you could go get another house. So, given the opportunity in which the market came all the way back up to 6,000, I said, let's get the frick out of the house. And especially because, and we'll zoom in again, especially because, especially because we were just right here a week before, and then the market goes up 300 points. So that's 6%, 7%. Where's my calculator? So annoying, calculator. So 300 divided by 5,600, 5.35%. Okay, got me. 5.35%. So we just had a 5% run, and that wasn't the only 5% run, because back here we were at 5,100. And back here we were at 4,900 a month earlier. Just 1 month earlier, we were at 4,900. We weren't sure we were going to hold 4,900. And all of a sudden we're saying 6,000 is a buy point, that I should start going into stocks. No, screw that. What's that horror movie? Get Out. Get out. That's what we're saying. So given the choices available to us and thinking it over and looking at the valuations and so on and so forth, you know, yeah, we had a lot of great stocks. Yes, we had a lot of value stocks, but they got killed. Our long portfolios, if you look at the April portfolio review, we got hit very hard in our long portfolios, and we got it all back as if it never happened. And I remember, and this is the problem though, see, the problem is investors tend to have this really weird selective amnesia. And, you know, it's like people invest and they forget what just happened. You know, things that just happened are out of their minds. I think even things that happened that were huge, like the 2008 crash, or the COVID crash, or the banking crash that was not the COVID crash, right? We had that banking crisis in between. So we had the 2008 crash. First we had the 2000 crash, right? The big crash in 2000. Then we have the crash in 2008. Then we have the COVID crash in 2000. Was it 18? I don't know. I don't remember anymore. whatever year that was. Well, you can see it here, right? If I just go to monthly, it'll probably show up. It's too much of a pullback. But anyway, we had this crash. So we had this crash. This is a, 1400 to 700 is a 50% crash. We had 1500 to 700, another 50% crash. Then we have this crash, 3300 to 2200. That's like a 33% crash, right? That was COVID. All right, that one was COVID. And then we have the banking crash, and that was 4700 to 3500. That's 1200 points, right? But then this time, this is a tariff crash, 6100 to 4700, 1300 into 6100, like 25%. Damn it. Excuse me. Ugh, green tea is not fixing this, I tell you. Anyway, so there are lots of crashes. I think that's the short story here. There are lots and lots of crashes for whatever reason. These are not the same reasons. This was overpaying for .com stocks. This is overpaying for financial stocks. It turned out to be pretty much a scam. And this is a scam basically being run by US banks and real estate companies. So banks and real estate, who you're supposed to be able to trust, they caused this crisis by running a scam. Then we get here, this is caused by a disease, which by the way is spreading again in China. A new variant is tearing up China right now. And then this crash is because once again, the banks don't know how to manage money. So they get to go at us again. And what's our solution? We deregulate all the banks. Trump comes back and deregulates all the banks. That's what we're doing now. So we're guaranteed to have one of these in the not too distant future. And at the same time, this is all into an AI bubble. And by the way, look, this is the .com bubble. Now we have an AI bubble. A bubble just means people are overpaying for stuff. That's what it means. Not in some cases insanely overpaying, but generally, like here's a real estate bubble too. But it doesn't mean that they're not worth it. It doesn't mean nobody's worth it. Amazon was worth it. Google was worth it. Not too many others, but there was some, and then the PC companies were worth it, Intel and Microsoft and so on and so forth. So the .com thing wasn't like it was stupid to invest in companies that are on the internet, but it was stupid to invest in any company that was on the internet just because they were on the internet, like pets.com being the classic example. Just because you're on the internet doesn't mean you're going to be long-term successful. I mean, Amazon beat out a ton of competitors. Now we have like Instacart and things like that, but back in the day, there was, I forget what they were called, there was a grocery company that was delivering groceries back then. It turned out the problem with these delivery companies was they are, and again, not Amazon, because Amazon did it right and somehow figured it out. But the problem with most of the companies who were delivering stuff is they were delivering stuff using their own people and paying their own drivers and whatever. And that's a bad model. That doesn't work. You have to, the gig economy thing is what made it work. But what does the gig economy run on? Apps. It doesn't run on .com sites. It doesn't run on the web. It runs on apps. Apps were invented, and that is really thanks to Apple, who not that they invented apps, but they made it popular that there would be these apps on phones, and the phone companies would be able to easily install them and maintain them, and that way you can hire someone with a phone and have them immediately able to access your company's website and get even proprietary information for the drivers and be paying them online, so on and so forth. You're just automating so much of the process that it makes sense to have short-term laborers do your work. And that's great because I mean, honestly, the gig economy does make sense. And in fact, I saw this good movie about the future. I forgot what it was though, but I saw this good movie about the future, and everybody had virtual glasses, and all you did was you go to the site, you just click on a site or whatever the glasses version of click on a site is, and it would take you to a job site and say, here's a job you can do right now in your area. Boom. Like I need it because somebody needs a body to do something like pick up a package from here and go here, or whatever. It's like so you get an immediate job, and then you're done, and the job is completed. You get paid, and you're out of the job. That's it. Now you go on to get the next job that comes up. That actually makes sense. Utilize you have unutilized labor, and you have workspace needs, and certain things can be done without much training, without any training for people. So like cleaning cars or going to pick things up at the store, doing tasks or whatever. We have that now. We have TaskRabbit and things like that accomplish stuff for you, but not in such a quickie way. But we will eventually, or we'll have robots to do it, one or the other. But crashes. So we have this opportunity. We have a second chance to get the frick out at the top, basically at the top again, and go to cash. And then we will mostly wait, because don't get excited. We're not buying 60 stocks next week or nothing like that. We are going to begin populating a portfolio very carefully, and we are going to wait until at least July something, middle of July, and see what happens with the tariffs. Almost certainly they're going to get kicked back. He'll kick it down another 3 months. The way Trump does diplomacy is a joke, but most likely what will happen in July is the tariffs will get kicked down another 3 months. But at a certain point, if he does another 3 months in July, you can almost say he's never going to do it. It's just always going to get kicked down the road. God forbid he does put these tariffs on in July, then the summer is going to be a train wreck. And who knows what's going to happen if they don't pass his tax bill. I mean, that's just nuts. And by the way, that's the point of kicking the tariffs down the road, though. See, the thing is, by imposing the tariffs at such outrageously high numbers, and then pushing them back until July, what Trump did is he allowed those numbers are now factored into how much, and we talked about that with the debt clock last week. Future tariff revenue, $600 billion a year. That's complete bullshit. We're never going to collect $600 billion per year in tariff revenue. But that's what Trump is proposing. And by proposing it and not actually negotiating it and not actually settling with anybody, that number is still on the table and is therefore being counted as income coming in, which keeps our deficit under, well, not under, but at $2 trillion, as opposed to $3 trillion, which it basically would be without the tariffs. So pretending you're going to do tariffs is how you get this number under control and how you pass the big, beautiful tax bill. Or lack of tax bill, as it should be known, not tax bill. And this is complete bullshit. Dodge proposed savings. And again, if you take away this number, which is 90% bullshit, and you take this number, which is 90% bullshit, and you add them back in, we have a $3 trillion deficit. So Elon Musk has already quit Doge. He's out. He's really out. He's not coming back. Like he's already bad mouthing the current tax bill. So I don't think he's coming back. So you just have these pretend numbers here, which the national debt clock did not used to be. I don't know who took it over and what went on, but it became very it became a very meager sort of thing now, the national debt clock. So you can't trust any of the things that you see here anymore. But officially, these are the numbers, and you just got to understand where they're coming from. Like this tariff revenue number is a fantasy. This savings number is a fantasy. You know, it's not a fantasy. Look at this. I keep saying 37 trillion. It is 37 trillion now. I mean, it was maybe 300 billion a year a month ago. It's like it comes up fast when you're going. You're not going 2 trillion into debt. You're going $3 trillion into debt, and our interest on debt is $1 trillion now. That's a new number. That used to be a couple of years ago. That was 400 million a year. Now it's 1 trillion a year. And Trump upped the military budget, is now over $1 trillion. I'm not sure exactly what they do. It's hard to tell what they're actually doing with Medicare, but we'll see. And all that was to talk about what? What was I trying to talk about? What's new in Chrome? Right, cash in. So that's why we cashed out. All right, let's get back to that. So that's why we cashed out. It was just a coincidence that we talked about it, the opportunity came up, the market went zooming up, and I was like, you know what, this is a good time to cash out. Let's get out of this market, and we're going to wait and see what happens. So in the ensuing time that's followed, which is only 2 weeks, and everybody like freaking out. When are we going to start the portfolios? I'm like, it's been 2 weeks. So let's calm down. So that was, I forgot what day I said now. 14th, okay. No, not 14th. 15th, officially 15th, we closed it out. So on the 15th, we decided to close it out, and that's also because, I decided in the morning, so whatever. I decided in the morning, but we were having a good time. The market was up. We were coming back towards 6,000. It was a fantastic time to cash out at great prices. And then boom, 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 down we went all the way back here again. And then we come back up. So anybody who didn't get a chance to cash out can now cash out. Great. So like I said, the thing is, when we were at 6,000, not here the first time, and this is why we made so much money on the hedges, because when we were at 6,000 the first time, I said, this is total bullshit. It was total bullshit from all the way to December to the end of February. It was bullshit. And I said it was bullshit. And that's why we had so many hedges. And we decided, though, that we would ride it out. We decided we would ride out the 20% correction. And so we hedged the shit out of our portfolios. We made a ton of money here. We cashed out our hedges. This was the brilliance of the whole thing. We cashed out our hedges at this line. And then we came back. We had some hedges, but not nowhere near as heavy. And we cashed out our big hedges here. We took this money off the table, and then and it was, here we had like 2 million something, 2.5 million worth of protection on the table. Here we cashed in about 1.5 million of our protection. We changed it to other hedges, but those hedges were more of the type where we would make money on the way up because we sold a lot of short calls. And then we went all the way back to 6,000. Why was this bullshit? This was bullshit because the stocks were trading at an average of 30 times earnings. And 30 times earnings is a 3.33% return on your investment. That's what 30 times earnings is. Like 20 times earnings is a 5% return on your investment. 30 times earnings is a 3.3% return on your investment. When you know that, where's Treasury? Oh, shut up. I am a member. You're so insulting. Stop it. I pay for you. No. See, this is whack. It's completely wacky. I pay for this. I can't log in. Let me figure stockcharts.com by itself. Let's see if that works. Log in there. US 10-year TNX. Now is that going to be the right number? No. 10-year. Damn it. Well, I just had it today in the post. Can I remember the symbol for that thing? There it is. Anyway, all right. So you can put your money in a 10-year bill for 4.45%. So why would you put your money in the stock market at 3.3%? 3.3% is way down here. So if you're paying 30 times earnings, you're getting a 3.3% return. If you put your money in a 10-year, you get a 4.5% return. I'd rather have a 50% more, by the way, of a return. And obviously, we know how to do better in the market than most people, but still, most people are the ones who are going to be setting the prices for the market. And it's really crazy that this kind of stuff gets ignored because people don't understand what these price multiples mean. Are you going to get your money back? Now, there are other factors like growth of the companies and growth of earnings, and that's what we were talking about NVIDIA today. So the company could be growing and earnings could be becoming larger, and that means that 30x today could become 20x next year, or if the company grows significantly in earnings. So there's other factors involved, but on the whole, when the market average is at that kind of rate, it means the market on the whole is overpriced. We don't buy every stock in the market. We don't buy indexes. We're not an index fund managers. We are value investors. We find the best values the same way Warren Buffett built his portfolio at Berkshire Hathaway, based on stocks that were very good values that we intend to hold for a long time and reap the benefits. Not only that, but unlike Warren Buffett, we put our stocks to work. He is a passive investor. He invests and he hopes the companies go up in value and make money. We don't. We actively manage our stocks and we figure out ways to draw incomes from them by selling options against them. So that's why we get our accelerated returns, because we just take it a step further. We buy the same value stocks. We have the same general principles in selecting stocks, but while we own them, may as well take advantage of it and collect an income. And I'm sure you guys have seen this, but I'll show you. Let's see. That's Stockopedia, but you're Stockopedia, aren't you? So only two of those. S&P 500 versus dividend investing. Should be a lot of charts of this. So yeah, this is generally the right one. So if you just invest in the S&P, you do fine. This is your return over time. So you make 6 times in whatever amount of time that is. 93 to 2017 is 24 years. Okay, so in about 25 years, you make 6 times on the market. But if you invest dividends and reinvest the money, you make 10 times. That's a lot more. 10 is a lot more than 6. It is 66% more than 6. And then what we do is we do options, which are even better than dividends, because by selling options, we can make 20 times. And that's insanely more money than you're going to get from the S&P 500. It's much more than Warren Buffett gets. The S&P averages 8% a year. Warren Buffett averages 16% a year. And we're like 30%. You know, we do 30, 40% very consistently. Why? Because you collect a lot more money in options than you do in dividends. And plus, we can pick stocks like AT&T, and we will. When we start putting money back into stocks, we're going to go with stocks that are safe and consistent like AT&T. So now I need this. So AT&T, and if you look at those old whiteboard videos that we have, AT&T is always the example. Like we always have, AT&T is always one of our examples because AT&T is a forever stock. The only reason AT&T doesn't grow in the traditional sense of growing is because AT&T pays out a tremendous amount of money in dividends, and that money is detracted from their overall long-term earnings. So they always end up being in about the same place, which is about here. This is their normal place. They had a rough time because they were reinvesting in 5G at this time. Well, first we had COVID, and then they started putting a lot of money into their 5G networks and so on and so forth. But now they're back into a cycle where they've already built all the stuff, and now they just collect the revenues. That's how it works. That's how cyclicals work. We love that kind of stuff. So AT&T is now back at $27. $27 is only $200 billion. That's like nothing these days, right? NVIDIA is going to go up or down $200 billion today when they announce their earnings. They pay out 4% dividends. They pay out 111 in dividends. How many shares do they have? 7 billion shares. Therefore, they're paying out $7 billion in dividends. Every year, $7 billion. Since 2013 to 2023, 70 billion, $84 billion, basically. So imagine that, $84 billion in dividends on a $200 billion market cap. So AT&T could have been a $280 billion market cap. They pay out the dividends, which is what tech companies don't do. All these tech companies that we worship, it's so funny how people, you know, they look at these dividend companies and they undervalue them, but meanwhile they go, oh, and then God forbid they don't pay a dividend, everybody freaks out. If AT&T stops paying a dividend, everybody freaks out. But meanwhile, the big tech companies don't pay a penny. They keep the money. What do? They keep the money, they reinvest it. That's $80 billion AT&T could have had to do stuff with. And that includes buying other companies, right? What did Microsoft do? They took $10 billion and put it into OpenAI last year or 2 years ago. They took $10 billion. AT&T had $10 billion. They paid it out in dividends. Microsoft had $10 billion. They invested it in OpenAI. It is insane to pay out that amount of dividends. It's like, you know, because you don't know what to do with your money because you're not creative. But anyway, so other than these periods of investing cycles where they go deeply into debt and invest, and then they get back and then they pay down their debt, and then it's time for 6G and they'll start another investing cycle. But at the moment, they're still finishing up 5G. So, but the point is, most of the time, AT&T is a wonderful flat stock. It doesn't go too far up. It doesn't go too far down. And during this time, we can do two things. We can collect our dividends, right? We can collect 4% by owning the stock. But in addition to owning the stock, so AT&T is at 27. We buy the stock for 27. Let's get Mr. Calculator involved in this. This is terrible. Okay. Oh, this isn't going to work. Got to remember the numbers. So buy AT&T for $27.50. In addition to buying it, we promise to buy more. So we go to January 2027, and I say, okay, well, I'll buy 1,000 shares for $27.50. That's $27,500. And now I can make the calculator work. There we go. So 27.57, but I'm going to also promise to buy more at 25. So I buy 1,000 for 27.57. I sell 10 puts for, let's say 22, let's say 245. So then I'm going to sell, so minus, well, I'm sorry, it's going to be times 1,000 shares. There you go. Then minus 10 of these for 245, so that's going to be 2,450. And I'm also going to sell the $27 calls. Look at the, oh, look at that price on those, 380. So 385, let's see. So then I'm going to sell for 385, 3850. We're going to sell that. So now what we've done is we bought 1,000 shares of AT&T for net 21,027. That's $21.27 a share. That's $6 off the current price, which is almost 30. Yeah, it's about 25% off. So 25% off the current price. If AT&T is below, we sold the $25 calls. If AT&T is below 25 in January 27, we are going to be forced to buy another 1,000 shares for $25, which is 25,000. So plus 25,000 is 46,270, and then divide that by 2 is 2313. So our worst case scenario is we will own 2,000 shares of AT&T at 2313, which is $46,000. So if I have a $500,000 portfolio with $2 million worth of, with $1 million worth of buying power, right? Then I'm going to have 10 allocation blocks of $100,000 each. And that means that this, if I'm risking owning $46,000 worth of AT&T, I'm using half of an allocation block for this position. And what am I getting for my half an allocation block? I'm getting the stock. I'm going to collect my dividend of $1.10, which is going to be $1,100, and I'm going to collect that twice, right, for 2 years. Well, a year and a half. So 110 plus what 55 is 1650. So now I'm going to take. So now I'm going to take off. Oh, wait a minute. Times 2 minus 25, 1, 2, 3. So that's my original investment. So I'm also going to collect 1,100 plus 550. So minus 1100 minus 550 is now $19,620. So now if I collect, if the dividends come in, I'm only in this stock for $19,620. If I buy more at 25, that's going to be 34. I'll be in for, is that right? No, if I buy more at 25, that's 45. Sorry, 45. 44. So we'll be in for like $22 a share. So if AT&T is over 25, that's our net entry, because we've collected the dividends against the stock, and that's in just 18 months. Now, meanwhile, while that's going on, what are we going to do? I've got the stock, so we can sell the September. It's at 27. Let's say we sell the let's say we sell the 28. That's a good price. So we sell some 28 calls for $1.40. So if I sell 10 of the 28 calls for $1.40, that's $1,400 we're collecting. That's using 114 days. So you see, we're getting the dividend, and now we're talking about collecting the stock money, and that's for 114 out of 597 days. So I should get 5 chances to make that sale. And what I say was $1,400. So if it's $1,400 and I've got 5 chances to collect $1,400, that is $5,000, $7,000. So $7,000 against what was our net entry? 19,000. So 7,000 divided by 19,000, 620, I think it was, is 35%. So now we're collecting another 35% back. But more importantly, and I didn't do the showing thing. Ugh, I need a bigger. There it is. What was the number? 19,000, 19,620. So it's $19,620 minus, what did I say, 7,000? Minus $7,000 collecting in calls. What? Well, it's going to be 12,620. I know that. So now, if I've consistently sold calls, it's $12,620. And that's the best case, though, because obviously if the stock goes up or whatever, I might have to pay some back. But at the same time, I could also sell the September, let's say we sell the September 26 puts for $1 or for 90 cents. So now that's another $4,500. So minus $4,500 selling puts. And now I've got 1,000 shares of AT&T for $8.12 per share. That's the difference between what we do and what Buffett does. Buffett just buys the stock and collects the dividends. Okay, and that's going to net you $27 minus $1,400 is whatever the hell it is. But he just buys it and collects the dividends. Is, let's say 26 bucks a share. We're down to $8 a share if all goes well. It may not go as well, but you know what? We more likely are going to do somewhere between. We're going to go somewhere between $22 and $8. We will win a significant amount of these sales. And when we win, in fact, as you know, I'm sure 80% of options sold expire worthless. Not only that, though, but by selling puts and calls, we are absolutely going to win half the time. And if we're lucky and AT&T is pretty flat, we're going to win on both sides at the same time. So now, in just 18 months, we've taken $27,000 worth of stock and we've knocked our basis down to $8,100. And if we get called away at $27,000, it's all profit. It's $19,000 worth of profit. That's outrageous. So that's why we start out with nice, inexpensive blue chip stocks, because we don't need to gamble. We do not need to take big risks. Okay, we are doing what? We are being the house. That is the PhilStockWorld tagline: be the house, not the gambler. We're running a casino. And what we are doing is taking money from both sides, just like any good bookie, and we are making money on the spreads. And we are effectively guaranteed to make money on the spreads. And sometimes we get lucky, like a bookie, and the score falls, which is the score would be where the stock finishes. Sometimes we get lucky and the score falls right between the spread and both sides lose, and we win on both sides. And in fact, unlike a bookie, that's why this is even better than being a bookie, because unlike a bookie, when we sell these puts and calls, somebody can win, but they won't win the whole thing. They only win the difference between what they said it would be and what it actually is. So we could lose and still win. It's freaking phenomenal. I gotta tell you how great this is. That's why it's exciting to start new portfolios. We get to do all this stuff again from scratch, and hopefully people learn and you know, it's a lifetime thing. This is a teach a man to fish kind of thing. When you learn how to do this, you will always be able to generate wealth. And what you just have to learn is you have to learn to give up, to not chase these freaking .com stocks, not chase the AI stocks, not chase the weird pharma stock that's working on a thing, blah, blah, blah. That's why when Pfizer goes on sale, I'm like, I want Pfizer. I don't want the guy who's working on some small little drug. You know why? Because if they do well, Pfizer will buy them. Pfizer's business model is to buy companies that have inventions in pharmaceuticals that are already proven out, that went through the FDA and so on, or at least went through enough stages where Pfizer can look at it with their team of scientists who are way better than anybody else's team of scientists, and they'll take the drug and they'll sign an NDA and they'll look at it and they'll tear it apart and they'll say, you know what, this is going to work. This is a winner. We like it, and they will back it. So if Pfizer's going to gamble, they're going to take a stage 2 trial or stage 1 trial and get on board with that after it proves out for at least one stage and it moves on with the FDA, or because a lot of companies can't afford to go through a stage 3 trial. That's expensive. And depending on the investing environment at any given time, but Pfizer always has money. Pfizer can always get billions of dollars and throw it at somebody. That's their business model, is to buy promising new drugs. People sit there and whine about the pipeline of a pharmaceutical company. It doesn't make any sense when you're talking about a company that can buy a team. It's like the Yankees. It's as if you talk about the Yankees and only talked about them, and I don't mean the Yankees now, but I mean the Yankees in the old days. You know, if you look at the Yankees when George Steinbrenner had bought them, and you said, well, you know, the farm team's not that great, so I don't see how we're going to have any new players. Steinbrenner's like, screw that. I'm going to buy the best player from every team in the league and put him on the Yankees. He just broke the business model. He said, that's not how you make a team. He goes, I'm not going to wait for talent to come up through the minor leagues and watch people develop over 4 or 5 years and then bring them up to the majors when they're seasoned and ready and blah. He's like, screw that. Get me Jim Hunter from the A's. He's like the best pitcher in baseball. Put him on the Yankees. Get me Reggie Jackson and put him on the Yankees. He just went shopping. He just took his checkbook and went, okay, let's buy stuff. That's what Pfizer's business model is. They just go through who's got good drugs. They go to these conventions from a totally different perspective than other people go to the convention, because other people are looking to invest in the companies that are showing what their drugs are and so on and so forth. Pfizer's like, we're buying this stuff. And they don't actually wait for the convention. They know. They're out there. They've got people talking to people and they're looking in every sector. They know exactly what's going on more than anybody. So I laugh when people talk about, oh, Pfizer's got a weak pipeline. I'm like, no, they don't. They have money. You don't need a strong pipeline when you have money. Anyway, so Pfizer's another one, crazy low values. And again, this is why I don't worry about, oh, what are we going to do? Are we going to find stocks? Are we going to miss the bus? No. Look at AT&T. It's only $27. $27 is 12.3 times earnings. I think we'll buy them. Pfizer. So our early stocks are going to be super boring, but they're super boring because you know what? I can make 200% on super boring. In 18 months, I can make 200% trading a super boring stock. So this is how we start building our portfolio. In 18 months, we could go from $500,000 to 1.5 million. And that's without taking any risk. Look at Pfizer. 2013, they were down here. Now they're at 23.23. It is 7 times their forward earnings. It's a joke. They pay a 7% dividend. They pay a $1.71 dividend. It's 7%. So there's another one. And trust me, the numbers will work also. When you go to look at options, oh, here's options. You go to look at options, September, Pfizer, what can I do? They're at 23. I can sell the $24 calls for $1. I can sell the $23 puts for $1.30. I'll sell those. I'll sell them right on the line. You know why? Because I don't care. What are you gonna do? Make me buy more Pfizer for $23? I mean, that's insane. That's my risk, is that I get to buy more Pfizer for $23. That's not a risk. That just makes me say, okay, you know what? Instead of buying 5,000 shares of Pfizer, I'll buy 2,500 shares, and I'll sell the calls, and I'll sell the puts, and I'm going to collect $1.37 here, and I'm going to collect $1 here, so that's like $2.37. So I'm going to collect 10% of my money back in 114 days. Just doing that. Plus, I'm going to sell, plus I'll sell some calls over here, some short calls. So I'll sell 25 calls, let's say. Another $2,000 here. So I'm going to collect $2,000 over here, and I'm going to sell these puts for $3. Of course, I'm going to sell the 23 puts for $3. That's another $3,000. I think this cost basis is going to be 0 by the time I'm done with it. That's how you buy stocks. Don't pay retail. That's the one thing that I disagree with Warren Buffett on, is he's a retail buyer of stocks. He buys stocks, he pays the full price. He waits for it to go on sale. He waits for the stock to be cheap. But I'm taking a stock that is cheap, like Pfizer. It's already cheap. Let's see, where's the Stockopedia thing? Here you go. Whoop. Hit the wrong button. Oh, it was Pfizer. Thought I hit the wrong button, but I didn't. No, something just, yeah, it was wrong. It's like a different exchange. That Pfizer. So, so you know what happened to Pfizer, because they made so much money during COVID that everybody got a skewed idea of what they were, worth, because they went way up during COVID. This 2021, 2023, because they went from, normal fluctuations, then they go to 21 billion, 31 billion, then all the way down to 2 billion in net profit. And then, because then they had to turn, so they lucked out. They got into the COVID thing. They didn't luck out, though. I mean, they co-developed it with Moderna. They gave Moderna a bunch of money, right? Like Microsoft does with AI. They gave Moderna a bunch of money and said, "Here you go. Let's have a COVID drug." And they had a COVID drug. So they got $50 billion of operating profit selling their COVID drug, because it really didn't cost them anything to do it other than developing it. Which wasn't very expensive. Then the COVID thing dies out, and then everybody goes, "Oh, where's your pipeline? What are you going to do? You don't have any drugs anymore. No more COVID." As if that's the only thing they're capable of doing. They just go out with their $50 billion, which is what they did here. They took their $50 billion, 50 billion in profit, another 50 billion in sales, and they said, "Oh, you know what? How about we buy some companies for the next to fill up our pipeline?" And they fill up their pipeline, and now the pipeline's paying off, and it's going to bring in 17 billion the next 2 years. So they're trading at 8 times sales on forward earnings. They got 44 billion in debt, but that's just the way that, some companies function that way. That's how they go. So it is another stock that we can make a fortune on by buying it. But like I said, so we're not in a hurry. And there's many stocks like this. The only thing, I'm gonna get worried when Pfizer goes up 10, 15, 20%. But even at 20% up, even if it goes up to $27, it's still pretty freaking attractive considering it's easily capable of being at 40 or 50. If it gets to 20 times earnings, that's 2.5 times where it is now. So 2.5 times 23 is 50, 60 bucks. That's it. So in other words, if Pfizer got to 20x, it would be 50 or 60 bucks. If it gets to 15x, that's still double where it is now. It's still 45 bucks. So they're massively underpriced. So it's not so much selecting stocks. What I worry about is where the hell are we? And like I said, the Fed's going to do things soon. All right. So I was going to say, like I said yesterday, and you guys can do your own homework on this one. So why did we get out? Because we got top dollar, we cashed in, we made a fortune, and now we put our cash back on the sidelines and we start again. I was looking at this stuff and I said, not here. Oh no, you're kidding me. Got logged out. If I say remember me. Where are the markets ahead of the Fed? Let's see that. Okay, that's where we are ahead of the Fed. So yesterday, before we were so rudely interrupted, all right, this is important. So yesterday, 10 o'clock, I said, I think the markets are behaving pretty unrealistically, as if all these issues magically disappear, not to be doom and gloom, but I asked Bodie what he thinks about it. And he said, Phil, you're absolutely right. The market's pricing in Goldilocks, blah, blah, blah. And I asked him, what are the top threats to the market? He said, here are the top 10 threats. Trade war and tariff retaliation. Obviously, right? This is, you don't need an AI to tell you that, but he's good at organizing things. Why it's a threat, the potential impact, and he's got his resources that he refers to. Likelihood, very high, 85% likelihood. He doesn't pull these numbers out of his ass. This is a calculating machine that can figure. He actually has calculated the probability of a trade war with tariff retaliations, and it's 85%. And he says this is already happening and escalation seems inevitable. 85% chance of the worst possible thing that could happen. Federal Reserve policy error. The Fed is caught between conflicting mandates with limited room to maneuver. That's bad. So there's various ways they can make a mistake now. Consumer spending collapses. We already see this happening. 75%. Data is already showing stress. Higher borrowing costs are biting deeper. Housing market implosion. Houses are not selling. The reason houses are not selling is because houses never corrected in price. Because the Fed, and again, this is exactly the same thing, the Fed keeps bailing out the housing market and the government keeps bailing out the housing market. And what are they doing? They lower rates to support prices. But now the rates are, well, they're not that low. They're like 7% now. But, but housing prices never corrected. Even through COVID and whatever, they really did not correct. The housing prices didn't correct because we had a we had a economic crisis in which people stayed in their homes and didn't leave. So they didn't sell their homes and go somewhere else. They just stayed where they were. And then the Fed raised rates, and now everybody's stuck in their homes because if you have a 3% mortgage, you can't sell that house and move to a place with a 7% mortgage. The place with a 7% mortgage is unaffordable. You end up having to downsize tremendously just to move out of your 3% mortgage house. So the real mistake in policy was the ridiculously low mortgages that drove up the prices of houses that people are now stuck in, and they're unwilling to lower their prices to get out, because they bought their houses at inflated prices because the 3% mortgage made the house seem affordable. But then there's property taxes have been creeping up, and school taxes and things like that have all been creeping up, and the fuel and everything else. So it's cost a lot more to maintain these homes, and just general inflation. It costs a lot more to maintain the home than it did when people moved in. So they're trapped in these homes and they can't afford to sell them at a loss. And that's another mistake. Everybody makes this mistake with houses, is they pay the minimum. Everybody, you get a nice house, an affordable mortgage, and instead of paying the mortgage down quickly because you have low monthly rent and you could easily make an extra rent payment once a quarter, right, and pay off the mortgage in a much faster amount of time, instead what homeowners do is they just pay the minimum. And then they gamble the rest in the stock market and put it into crypto or some bullshit like that, when you should be paying off the house so you don't have a mortgage. Even if it's a 3% mortgage, pay it off. Just don't have a mortgage, because this is how you get stuck in a house. So home sales are at 20-year lows. The 30-year mortgage rate's at 6.92%. The housing market is frozen. Unless housing prices come down considerably, which is of course going to kill people who have homes, it's going to be a complete disaster. And this is going to happen. Fiscal crisis, debt ceiling. Well, obviously we know that's happening. I don't know how you get 65% out of that when it's totally happening. China. Why is China a threat? Decelerating growth, stimulus measures aren't working. The property sector correction continues. Deflationary pressures persist. China is the world's second largest economy. Blah blah blah. A hard landing there is bad. China's. I've been talking about China for years now. This is a real slow motion catastrophe happening in China. Geopolitical stuff, Russia, Ukraine. Oh, it's accelerating today. We were just yelling about that this weekend, right? So that he only puts that at 50%. I think it's higher. Corporate earnings recession, and we know, obviously, again, it goes back to tariffs and everything else. We're ignoring this fact. These are just the top 10 things, and they're all like basically happening at the same time. Any one of these things would be a reason to be careful. Any single one of these would be a reason to be extremely careful about the markets. All of them. I guess the thing is, there's so many bad things that everybody's just like, I can't think about it. I'm not going to pay no attention at all. AI bubble bursting. That's not that likely to me. I just think AI/robotics is the future, and it's probably the only thing that's going to really save us, is just this entirely new thing. Just like the internet, right? The internet was an entirely new thing, and people invested, and now it's like a total part of our lives with nothing. How would this world function now without the internet? And that's from this entire century. Since the beginning of the century, everybody's been investing like crazy in the internet and putting money into it, and now we're past the internet because everybody has the internet, and because it's everywhere on earth all the time, and because you expect internet access everywhere in the world. That's why we can now say, oh, we can have self-driving cars because they're always going to be connected to the internet. We can have robots because they're always going to be connected to the internet, because the internet is everywhere. All this 25 years of internet spending has created an infrastructure that we take the internet for granted, that we can't believe that. Anybody who has kids know this. You can't believe there's no internet. Whenever you're in a place where there's no internet, your kids go, oh. It takes about 10 seconds from entering a place where there's no internet, where they go, oh, wow, as if they're being tortured. That's because we expect it, though. We don't expect ever to be in a place where there's no internet. And then there's credit market stress, and he says 7 out of 10 threats have a 60% likelihood of occurring, and blah, blah, blah. So what does that mean? It means we should be very happy to be in cash and stay on the sidelines. It means we probably should just take a vacation for a few months and just ignore this crap, because this is horrifying. And those are just the top 10. Now let's see what the Fed said. Here's the Fed. Nope, it's not. La da da. Warren. China. That's Bodie. This is. Dun, 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 dun. Oh, sorry, that's Warren. It's May 28th, and we have Fed minutes. Do you have the prior meeting loaded? So minutes, HTML. Whoops, I should put that. Silly me. Opened it up in the wrong thing. There we go. Very nice. Warren says, what are you saying? What's the matter with you? Uh-oh. Maybe I should have reloaded it first. Am I logged out? Okay, overview May 6th, 7th Fed meeting. Was that the prior Fed meeting? No. So I'm asking him, do you have the minutes of March 18th, 19th? Huh. Sorry. The question is, do you have the minutes for March 18 through 19 already loaded? Okay. La da da. Ish. Copy that. Well, I didn't really want it. Okay. Here are the minutes of the, well, it says so somewhere, doesn't it? May 6th, 7th. Here are the minutes of the May 6th through 7 meeting. Let us know what's changed and what insights you have comparing the two meetings. That's an amazing amount of text that he just takes in, right? Here we go. Boom. Oh, JD Vance is talking at the Bitcoin conference. Here's my remote. Oh, no, they cut away already. Trump media has $2.5 billion worth of Bitcoins. Isn't that insane that Trump media can have $2.5 billion worth of Bitcoin and then Trump is running around making policy on Bitcoin? Isn't that like the definition of corruption? All right, so, oh, I can't do the reading. I wonder if I can put him in talking mode. Use voice mode. If I use voice mode, it's going to go to our picture, I think. And we won't see it. All right, Fed funds rate. Balance sheet strategy. You guys have to read. You have to do some of your own reading because I can't just keep talking like this. Balance sheet policy. The last time they reduced it to $5 billion a month, which is a joke. You know, with a $7.5 trillion outstanding balance sheet, it's going to take 165 years to fully reduce. QT continues. Blah blah blah. Economic outlook solid growth. Real GDP slipped due to export swings. Inflation, progressive disinflation, tariff-induced inflation expected. Labor market review, stable labor market, still solid, but risks of deteriorating growing. So things are not getting better. And again, what the frick are we doing running back into stocks when all this is happening, right? There's too many negatives. Financial stability, no major concerns. It went from no major concerns to risk being flagged. Global developments, minor attention, some stuff now. More central banks easing, global trade tensions rising, recession fears. How is any of that better? Tariff impact. Tariffs noted but minimal economic impact discussed. So on March 18th, right before, and tariff day was April 2nd or something like that. March 18th, no, you know, tariffs, but we're not worried about it. Then by May 7th, major concerns, front-running imports, consumers, and businesses. Forward guidance. Cautious stance focused on inflation. And the same thing, inflation persistence, blah, blah, blah. Market reaction sensitivity. Limited commentary, Powell's press viewed as impactful, but what happens after but? How do you, that's weird. Volatility high, dollar weak. Oh, the dollar started getting weak. That's right. The dollar collapsed during this time. It's insane. I mean, it's the difference here. Just this difference here should tell you why we cashed out. Rising economic uncertainty and inflation pressures. Inflation was somewhat elevated by May. The narrative shifted meaningfully with the Fed acknowledging tariff-driven inflation surge. The implication the Fed's inflation fighting credibility is being tested. This could delay or derail the cut expectations. Growth outlook worsens, but real economy is still resilient. Yes, it is. It's extremely resilient. Got to give it that. But just because it's resilient doesn't mean it's not going to break. GDP contracted. That's right. And by the way, yeah, we kind of forget that we have a GDP report tomorrow. Our GDP was negative in Q1. It's negative. When you have 2 quarters of negative, it's a recession. We have one now. The Fed sees the GDP dip as a statistical quirk and not recessionary, at least not yet, but business sentiment is collapsing and investment is being deferred. Labor market is still strong but cracks. Early signs of hiring freezes, sectoral weakness, wage growth moderates. Despite policy paralysis, unless a material uptick in employment appears, this reinforces the Fed's wait and see. Tariffs. Tariffs were now they're front and center. We know that. The Fed is cornered. They can't fight supply side cost inflation without tanking the economy unless tariffs are rolled back, which is unlikely. Stagflation is the base case for the second half of 2025. Base case. That means that's the likely expectation. Financial stability and market signals. Made warning signs. The VIX is elevated. No, well, not at the moment. Unusual correlations. The dollar is down and yields are up. Hedge fund leverage, private credit flagged. The Fed's balance sheet unwind and QT remain ongoing, but it's not really because it's down to 5 trillion. It's not. See, I don't agree with that because it's 5 billion a month is a joke. Powell is clearly watching the market fragility closely, likely to hold QT entirely if stress worsens. So that's what he's done. And I said that when they did it, is I said that's essentially the same thing as a rate cut. When you were tightening by 25 billion a month and now you're tightening by 5 billion a month, you've effectively dropped 250 billion on the market. Strategic takeaways. The Fed is firmly in reactive mode. No clear pivot to easing yet, but the Fed is preferring to reverse course. The markets may be too optimistic, pricing in 3 cuts. I don't see how anybody can believe there's going to be 3 cuts. Liquidity injections may continue off balance sheet despite the formal QT language. That's really scary. The Fed is going to lie to you is what that says. The Fed will lie to you because things are so bad and they don't want to say it. Therefore, they're just going to pretend that it's fine and they're going to keep pumping liquidity in. That's a terrible idea. That's a non-transparent policy. Investment strategy should be agile. This is not a set and forget. Macro environment, it's a mess. So very, very bad. Which is, nothing. It's nothing different than this. It's what we said yesterday. But specifically to America, globally, it's a mess. Thank God we're in cash. Other than the weakness of the dollar, unfortunately, but still, you know what? We went to cash, and the dollar is weak, and that's why the market is high. The market is high because the dollar dropped 10%, which pushes the market up 10%. So the market would be 10% weaker than it is now. Would not look like a recovery at all, if not for the incredibly weak dollar. If not for currency. So if not for this, okay, then we would not have this. This is the dollar dropping. This has got nothing to do with stock strengthening. It's just the thing that the stocks are priced in became smaller, and therefore you need more dollars to buy the same stock. So, yes, we are sitting on weak dollars, but in theory, we hope that 100-ish is the bottom. Let's go to a longer term chart. See how we bottomed out here? So we hope this is pretty much the bottom, down around 100. And if not, we've got some problems. But look how long it's been. It's been since 2015. We haven't fallen below 90. And that's our old range, was 90 to 100. And then we moved into 100 to 110 range. Now this is being tested. And if we fail this range and go back here, that's a huge step backwards for this country. And that would be a problem for us if we're sitting in too much cash and that happens. But I think that the dollar should be bouncy because as weak, as undesirable as the dollar may be, there really aren't any strong alternatives right now. Just because the euro exists doesn't mean that you can just buy more of them. There's a limited supply. That's why they have value. Same thing for the dollar. There's a lot of dollars out there, but there's still a limited supply. That's why there's a value to it. And when people want to go back to US equities, they're effectively taking dollars and buying US equities. It should strengthen us a little bit. We should get a little bit better. And I think there'll be a floor. I think we can hold this 100 level unless Trump does really stupid stuff, which is very possible. All right, that's about it for my voice. Cody says, can you explain more on the PE of 30 means and how you'll get a 3% return? I don't get that. Sorry, I'm an idiot. Okay. You know what, Cody? Definitely ask me in chat, though. I can have Warren do a thing for you and explain it because I just don't have the amount of words left in my throat right now. It's just math, though. If a stock is trading at 30 times earnings, it means it's going to take 30 years at this amount of earnings to make the money, right? So, you know, to make it simpler, if a stock is trading at 10 times earnings, so if a stock's $100 and it's making $10 a year in profit, then the PE would be 10. That's 10 times earnings. So it's going to make all your money back in 10 years. Okay. If a stock is $100 and it makes 3.33 in earnings, it's going to take 30 years to make the money back. And the PE is then 30. So it's just basically, it's interest. Think of it like an interest payment. How long will it take you to get your money back? And so you have to compare your investment. So if you're looking at a stock that's got a PE of 25, it's going to take 25 years to get your money back. That's 4% per year. And then you've got to look at that and compare that to what else could you be doing with your money to make 4%. And is the thing you would do as an alternative a safer, easier, better investment? If you have a bond, it's basically the same as having cash, except you're getting an interest payment. So if you can get cash, you know, like the bank will pay you 2%, 2.5%. That's liquid money. You can take it anytime and change your mind and do something else with it. A bond, there's a little bit more effort in getting rid of a bond, but on the whole, you can liquidate a bond very quickly. It's as good as cash. If it's a stock, you've got to sell the stock and hopefully it's in the right place and you're going to get the good value today and whatever. So it's different choices and it's different uses for your money. How did you come to learn all of this stuff? It's amazing. I love the Teach Amanda Fish comment. Again, oh, you know what you should do? There's a Forbes article on me, so you should read that. Forbes interviewed me and I talk about like how I learned to trade, but the bottom line is my grandfather was an investor and he lived in England, and I learned from him. I mean, when I was like 7 years old, he would give me the newspaper, and because I'd come out and visit in the summers, and so, and this is 1970, so there's not like there's lots of things to do. It's not like now where you're constantly distracted. Like, so there's like, during the day, what do you do with a kid? So my grandfather's idea of fun was he would give me the Sunday paper, because back then stocks only came out on a Sunday. And we would go through the newspaper, and my job was to circle stocks that made new highs or new lows. And then we would try to do some research, reading the paper, or sometimes going out to the library and getting microfiche and looking at the different stocks and how they did. And we would do research, and he would find out why did it make a new high and a new low, because he was a fundamental investor. And he would just go out and do some old-fashioned research. And sometimes when we were in London, he would actually go to the companies, and this is crazy, but this is what you could do in 1970. He would just walk up to the company, knock on the door, and say, "Hi, I'm thinking of investing in your company. I'd like to speak to somebody." And the companies didn't really have investor relations. And it was funny how many times, we would go in and they'd be like, "Here's the vice president of the company." You could sit down and talk to him. And it was too funny. And my grandfather wasn't like Warren Buffett or anything. I mean, he had millions of dollars, but he was not a massive known investor. But back then, life was just freaking simple. It really was. It was amazing how different life was in 1970, or the 70s. And I'd be sitting there. You take me with him. He was like, "It's a good thing for you to learn business." He was like, this is what you do when you're a man." And he's like, "You're gonna go come with me and do that." And then we go out and do something fun. We'll go to the park, go to some fairground or something like that. But he thought it was a good part of my education while he had me for the summer to just bring me around. And I'd be sitting there while he's talking to like a upper management of a company, and he would be drilling these guys. He'd be like, "What are you doing this? Or why is this? And what do you got here? And I see this. I notice you're doing this." So I just always thought that was normal. And so, because of my grandfather, and he lived until 1998, it was always a part of my life. And then because I had my grandfather's knowledge and my father did not, my father had nothing to do with it. Of course, obviously, you never want to do what your dad does. So my father was a computer programmer, didn't know anything about finance. So I was the one the family came to for all this stuff, for stocks and all that. And that's how I kind of got into it. And that's how I ended up being the stock guy. So I've been the stock guy since I was a child. And when my grandfather died, I was the official stock guy for the family. I was 1998. I was already 30. Really? Yeah, I was 35. Okay, so I was 35 in 1998. That's right, because I was just getting married. I didn't get married until I was 35. So until I was 35, I was already getting old. My grandfather lived to he was 98 when he died. And that's how I got into the markets. I mean, I just followed my grandfather's footsteps basically. And then I went to college, and when I got out of college, I started a company, and then I sold that company, and I kind of retired, and then I got heavily into trading then. This is still back in 2005, something like that. So in 2005, I basically started becoming a full-time trader. In 2007, I started PhilStockWorld. And again, it's because I was in my family, I was the trading guy, and then I became the trading guy for like everybody else too. And that's the story. Anyway, all right, now I'm going to stop talking because I don't think I can anymore. Thank you, everybody, for coming. I appreciate it. And next week, we're going to actually be at the point where we might start picking a few stocks for the new portfolios. All right, take care, folks. Thanks.